Well, here we are for lesson number 6 in taxation. We have, following this, 2 more class periods and we will be done and moving on to new subjects. So today we're going to take a look at a couple of areas in the textbook regarding stock dividends and what we call liquidating dividends, meaning what happens if we liquidate the company. That means go out of business and sell the assets. So we'll be taking a look at those too. Our lesson 6 objectives are as follows. Understand the treatment of a stock dividend as opposed to a cash dividend. Here we're talking. Number 2, define liquidating distribution. And number 3, describe the tax implications to shareholders related to a liquidating a corporation. Okay, so we will cover those. On page 19, we'll look at stock dividends, and on page 20, we'll look at liquidating dividends. Following that, we will take up 4 lesson activities or discussion questions to be answered, and we'll take a look at those right after we review the pages that we're studying today. So page 19 of the text deals with stock dividends. A stock dividend is a payment in stock, not in cash, and sometimes you have an option on which one to accept. So we'll take a look at the general rule, which is this. The original stock, if it's a common stock, if you have an option for cash or stock, then that dividend is taxable. If you have no option, that means the company is just giving you stock and no choice of taking cash, although you could sell the stock later on the market. That event is non-taxable. If it's a preferred stock, it doesn't matter if you have an option or not. Any preferred stock dividend is always taxable at the time the stock is issued. The shareholder's stock basis is the allocated between the old stock and the new stock dividend for future sales. We then look at the basis of the original stock here. We take the full market value of the original stock divided by the total of the original and the dividend and multiply that times the basis of the original stock, which would show then the basis of the original stock. And then to calculate the basis of the dividend stock, we take the full market value of the distribution and divide it by the total of the original plus the dividend, and that gives us the basis, or multiplied by the basis of the original stock, and that gives us the basis of the dividend stock. So when you have the page in front of you, the formula makes a lot more sense. There are some exceptions to these rules. If the stock dividend is taxable, given the option to receive stock or cash, or a disproportionate distribution. This means something that I don't know, so we'll have to take a look that up. Stock basis is always computed at full market value of the stock at the time the dividend is issued. Dividend income up to E&P reduces the basis, and the excess is taken in capital gains. We'll have to take a closer look at that in class. There is a holding period from the date of the distribution, and the corporation does not reflect this in gains or losses. Okay, page 20 deals with a liquidating dividend. A corporation is liquidated when the business is unsuccessful or the shareholders wish to buy the assets of the corporation. The corporation can deduct expenses related to liquidating as ordinary and necessary business expenses. So one might hire an attorney to draw up papers of liquidation. There would be other miscellaneous expenses in there. Those are all deductible. If we are liquidating to cash, that means selling everything down to the walls, so to speak. The current impact on the corporation, no effect. On the shareholder, the dividend income, stock basis, and capital gains currently due are all calculated. And if we're liquidating in the form of property, that means just distributing the assets of the firm rather than selling them. They must be calculated at the maximum of either full market value or adjusted basis for the corporation and for the shareholder. Tax consequences to the corporation. It's treated as if it sold its property at full market value. If the liabilities are less than full market value, liability is ignored in calculating gains or losses. And a gain or loss is recognized on the sale of property following the adoption of a plan of complete liquidation, even if the corporation then distributes all of its assets within 12 months after the plan of liquidation is adopted. Our discussion questions, again briefly. Number one, explain the concept of following controlled groups: parent, subsidiary, brother, sister, and combined. This is a new topic that we haven't discussed yet, so we'll take it up in class. Number two, discuss the tax treatment on gains and losses of affiliated groups and controlled groups. And number three, distinguish accumulated earnings tax from personal holding company tax. And finally, discuss the requirements to be a personal holding company. Again, all four of these are new topics, and so we will discuss them in class and how to go about coming up with answers to those. Do complete the online quiz, of course, by 11:59 Sunday, and we have actually extended that to the following Wednesday. Keep in mind that the final exam is not extended past the Sunday deadline because we're then turning in grades. I'll remind you of that with lesson 8 when that arrives. I see that I have made a mistake here, and I read to you lesson 7 discussion questions. So let's back up on those. You had a little preview. And let's take a look at very quickly at lesson 6 discussion questions, which are topics we have talked about. Number 1, generally, stock dividends are not taxable. Discuss when stock dividends are taxable. Number 2, discuss the liquidation process of distribution. Number 3, corporate distributions on property to shareholders on their stock are subject to 3-step treatment: dividend, return, and stock basis and gain. Discuss the rule for the 3-step treatment. We'll have to look at that in class carefully. And finally, number 4, related to liquidating corporation, describe the tax consequences to the corporation and to the shareholder of a liquidation or complete sale of the business going out of business. That brings us up to speed, and we'll hope to see you in class and discuss some of these issues face to face.